Hello, everyone, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way to exit highly appreciated assets tax deferred, so you create, preserve, and grow your wealth. I'm your co-host, Pearson York, filling in for Brett Swarts. And each episode, I'm joined by some of the best wealth, business, real estate, and leadership individuals in the world to share ideas, deal stories, and inspiration. So together, we can make complex tax deferral strategies simple and passive income plans achievable. As always, we're streaming on expertcresecrets.com, the Capital Gains Tax Solutions YouTube channel, Kingdom Luxury Realty Facebook channel. So please rate, review, subscribe, like, share, comment, all that good stuff. And that will really help us out. Our next guest, I'm super excited about. He's been in ground up development for real estate for the last 20 years, has a new hyper focus on self-storage. And so we're going to have a phenomenal conversation with Drew Dolan. Drew, how you doing, man?
Killer. Thanks, Pierce. Thanks for having me. This is awesome.
Yeah, absolutely. Absolutely. So how'd you get started in real estate?
You know, I got an engineering degree and I worked in construction in San Diego for like 6 years. And I was one of those engineers that got the degree and it's like, oh shit, what do I do with this thing now? So I went into sales and I spent a lot of time working with developers. And I just thought, that's what I want to do. I want to be at the top of the food chain. I want to control how projects get done and, you know, make the decisions. So I was just like completely attracted and enamored with it.
Yeah. So basically not letting anyone else, create your success, right? Just having that, that's a pretty strong internal locus of control over there. Sounds like. So what are one or two gifts that you have, spiritual gifts, strengths, superpowers, whatever you want to call them, that have led you to be successful today?
I am a grinder. You know, I think perseverance is a key for anybody in this business. And I can take all kinds of garbage and just grind it out every day, show back up, do it again. Think about the small wins, think about the long wins, this business, it's still America. If you want to create wealth and do what you want to do, I mean, people say the opportunities are not there or the American dream is dead. And I completely don't believe it. I think there's more opportunity, especially for somebody that wants to start a small business. That's what the pandemic did there's more small businesses that have started in the last year than in the last, 20 years. And there's so much opportunity. So anyway, that's how I feel about it.
Yeah, awesome. So basically just your work ethic and your ability to just take the crap, because it definitely comes, and work through and problem solve and figure it out to make it happen.
Yeah, exactly.
Nice. Cool. All right. So let's dive into this. So what are you focusing on right now? And what are you currently doing given the market situations to kind of hedge? How are you planning, preparing? What are you buying? Tell us what's the strategy? What's going through your head right now?
Yeah. So after 20 years of ground up development, from multifamily to senior living, hospitality, I'm completely focused on self-storage. I got into self-storage about 6 years ago. And really, I loved the growth story of the asset. And I loved just the business behind it. And maybe it was because I was just exiting senior living, where we were building assisted living, memory care, independent living facilities. And that isn't real estate. That's an operating business. Even if you're not the operator, even if you own the real estate and you hire the operator, it's still an operating business. You have 60 people, you have nurses, you have doctors. You're dealing with very people in very delicate situations. You're dealing with happy and unhappy kids of the customers, of your tenants. And, that became really tough. And I thought we were getting into real estate, or that was my anticipation, but I just had to learn so much from the operating business side. So self-storage, I'm I love self-storage in that it's a complete commodity product. And what I mean by that is when somebody's going to use self-storage, I need it tomorrow because I'm moving out. They think about how close is it to my home? What's the unit size available and what's that price? And beyond that, they're going to pay attention to, is it safe? Is it secure? Is it clean? But if that's all equal, they don't care whether it says public storage or extra space or Joe's self-storage. It's a commodity. They need it. And typically it's a short-term decision for somebody. And so what we do at DXD is use data and proprietary analytics to look through all that data and make decisions about where we should invest. And I think storage is very uniquely teed up or able to use data at a high level.
Yeah. I love what you said there, because I didn't give two craps if it said extra or public or whatever. You're so right about that. Like, nobody is like, oh, I'm not going to this self-storage because it's not self-made self-storage. No one cares. You're so right. So that's awesome.
It might be the product that has the least brand loyalty.
Yeah. Yeah, no, definitely. Okay. So tell me about how you're using data and obviously it's creating a competitive advantage for you guys. So explain that.
Yeah. So self-storage as a business, it's kind of decades behind other asset classes from capital maturity. 70% of it, 75% is still owned by mom and pop regional operators. The REITs are not dominant. The institutional players, public companies are not dominant in the sector. So you have a lot of fragmentation, a lot of mom and pop shops. There's 55,000 storage facilities. So I just love the aspect that it isn't as mature as some of the other asset classes, which to me means there's just, more opportunity. And we have a very unique partner in that I founded DXD Capital with a guy named Corey Sylvester. Corey and his partners created a company called Radius Plus. Radius Plus is the premier data set for self-storage. So if anybody out there is thinking about getting into self-storage or in it, you go to radiusplus.com. They have identified all 55,000 storage facilities. They scrape the rates for 35,000 of those facilities, the webs for 35,000 every night, and have years and years of rate history. So they have all this incredible data. And really what DXD does is it takes that data and then outside data sets that we think draw a picture of what demand could be, because we do acquisitions, but we're primarily focused right now on ground up. So we can look at the entire US from rates, existing and new supply, what are the demographics, job growth, home growth, zoning, all those things, and say, hey, this is where we should be investing. This looks like a good opportunity. And a lot of the other self-storage developers, they start with a site. Hey, that looks like a good site, or this feels good. They look for a site and then they look for the metrics, the data around it to support that decision. And we've done it the opposite, where we start with the data. We start with macro and we can look really anywhere. And that's, our company's building from Long Island to Hawaii. So we're not constrained on where we develop. And that gives us just this incredible opportunity to go where, we feel we can make outsized returns for our investors.
Okay. So let me ask you this. If there were someone wants to get into a development of self-storage, right? What do they need in order to have a successful operation? What do they need to do?
Well, I think you got to make the decision. Do you want to buy existing or build? And it's a rather tough time to buy existing because there is so much money that has poured into self-storage, sophisticated capital. This is money that was going to hospitality or office or senior living. That's not going there. It hasn't been going there the last 2 years. And it went into data centers and cold storage and self-storage. And that's driven prices way up. Now, as interest rates go up, those prices will have to come down. So there is a pending shakeout. It doesn't mean you can't find an existing great acquisition deal. I'm just saying from a macro level, the pricing is really high right now. So we're focused on ground up development. We will find off market acquisitions, but on ground up development, you got to have capital. You got to have a strategy. You got to pick great sites. So happy, Pierce, to dive into any one of those you think as we're talking about.
Yeah. Okay. So back up here for a second. So you're focusing on the ground up development, starting with the macro data and pinpointing your markets. And then you're going from there. What are 2 to 3 things that you're looking for in the market that are like the key indicators, like, hey, this is a site, we're going for it? And if they don't have those, are they like immediately dead?
Yeah, great question. It starts with rates, because the REITs who own the better properties and better markets, bigger markets, better located, they are changing their rates every day. And that's why storage is really uniquely positioned to track inflation, because you can change what rates you're offering that facility every day if you want. And every lease that gets signed by our tenants, it's a 30-day lease. So you could change the rates on that lease every 30 days. Now, if you did it every 30 days, people would probably move out, but you could. So we start with rates because of that pricing dynamic. Rates are the best indicator of how healthy or unhealthy the market is. And the analogy I like to think about is, imagine you're going from New York to Las Vegas. It's New Year's Eve. It's the last flight of the night. You have to be there, and there's one seat left on the last flight. Do you think that price is going to be expensive or cheap? It's going to be very expensive. And that's the same thing in storage. It's a lot like airline prices. It's extremely dynamic. You even have some of the more sophisticated operators they'll change pricing intraday now. And that's where a lot of the smaller operators, they don't change pricing, which means they're really not capitalizing on what the market is doing and how the supply demand curve is either in balance or completely out of balance.
That sounds like a lot of volatility to consistently manage. How do you manage the consistent rate changes?
Yeah, everybody needs a program. We use one of the REITs to operate our facility, so it's mostly public storage or extra space, but we can use Life or CubeSmart. And because we don't have to be the operator, it does allow us to go anywhere in the country, versus if we were the operator, it would be more difficult. We would need scale in a certain area. So what our job is to stay hyper focused on the asset management. And so we don't necessarily let the REITs dictate price. We talk about what the strategy is, and we let them go execute that strategy until that strategy needs to change. And so we do give them some leeway, but the reality is we're hyper focused on pricing. Same thing if you're going to do it yourself. If you're going to manage it yourself, there's software out there. There's pricing algorithms out there that you can do it with. So it's not the last thing you should be doing is guessing, but you're going to have a good feel, especially if it's the last 10 by 10 on the ground floor or the last climate controlled by this. And think about it this way: self-storage should never, be 100% occupied. It almost can't be, because if we have 1,000 units, we have churn of about 7% a month. But anytime you're above 90%, it means you haven't risen your rates high enough. It means you haven't raised rates high enough, really to capitalize on the demand. We used to think, 5 years ago, that stabilized was 85%. If you look at the REIT occupancies now, they're like 95, 96% occupied, very highly occupied. That's a great sign that there's really a lot of demand.
So how do you guys have a program that will like automatically, or bot that'll like change the prices based upon an algorithm you guys set, or how does that work?
Yeah, I mean, back to, yes, the REITs do have very sophisticated algorithms that they've built, and they think about things like this. What are the competitors doing? So they input competitor pricing, and they use that as a component. They look at what time of a year it is. If it's Labor Day, a lot of people move on Labor Day. We better raise prices because a lot of people are going to move. So they look at, historically what happened last year. And if it's a very slow month or weekend last year or a day, they might lower prices because they know demand is going to be slower. They look at which units you have left. So, a lot of it's done algorithmically, but you still have to have a macro strategy that you're targeting. And when I say macro strategy, one of the levers with self-storage, you built this facility, it's brand new, you got 1,000 units. How are you going to get them leased up? You really have two levers. The first lever is marketing, and that really today is SEO. You pay Google, which is getting more and more expensive. You pay Google to advertise, and maybe you pay up to be on, or you use a site like Sparefoot. Marketing can only get you so far. The real lever in self-storage is price. If you get a brand new facility and you need to lease up, you lower price 20, 30, 40% below the market. And then what happens is when somebody's shopping on the web, because that's where they're going to go to shop, they see that you're $40 cheaper. They're like, oh, no brainer. I'm going over there, because people are very price sensitive for self-storage. So
Yeah, that's fair. Totally fair.
yeah, what happens, I'll say, is you bring people in at lower prices, and then you got to get them up to market. And so there are actually two stabilization events in self-storage. The first is you've stabilized from an occupancy standpoint. The second is you stabilize from an economic standpoint. So you might be at 90% occupied, but your average rates are way below market, and you're just working month after month after month to get those rates up.
So it sounds like the turnover is actually an asset in this particular case, as opposed to some of the other asset classes where it's not necessarily.
It absolutely can be. And think about it this way. If you're 110, so you came in, you rented it, you started at 80, 2 years later, you're at 110. There's a new facility a mile away, and it's renting again for 70. Is somebody really going to go take a Saturday and move their stuff out?
I'm not.
To $40? It just doesn't happen.
I'm not.
So yeah, turnover does allow you to get rates up. And when 60% of the people pay on a credit card, it's like, I get my credit card statement. I don't know what that Apple or Amazon charge was. I have no idea. And I'm not even going to go track it. Right. And the same thing with self-storage. They just click over. It really, self-storage was one of the first subscription models.
Really is.
When you think about how it functions.
Yeah. Yeah, it really is. It's nice. And people just love their, like, I can't tell you how long I had just junk that was not worth what I paid for in storage to hold it there. And then I had to move it twice. I'm better off just selling it.
Yeah, that's exactly right.
So, anyway, so, all right, where exactly are we with what you guys are doing in the market right now? How are you guys handling it?
Yeah, we're developing. Okay. Development is really tough. I think it's the toughest moment of my career to develop, because you've got extreme prices in construction. Prices are going way up. Like, it's really hard to predict. We've got a project that's going to take us 48 months to get entitled. So how the hell do we estimate what that price is going to be in 48 months? Well, you got to do your best, but you got to have a really wide margin. You got to be able to make a lot of money, because construction prices are going to go up, and you hope lease rates are going to go up too. So construction prices are a problem. Obviously, interest rates absolutely have an effect. Supply chain. I mean, we're waiting on a transformer on one of our projects that we've been working on finding it for 9 months, and it's going to cost us an extra month. in delivering that project. I mean, this is something I've never faced in my career, but I think the most significant hurdle to development at the moment is the approvals from cities, the municipalities, who they're working from home, which means they're not working.
That means
if we're having a hard time finding people, imagine a city advertising for some assistant planning director. They have no technology that allows them to do things efficiently, and so cities are a nightmare. Even cities that, and I don't want to broadly paint them all the same, because there's cities and municipalities that are doing great,
right.
But there are ones that are really, really struggling. So that's costing us an extra 6 to 12 months, and that's a real impact on the value and the returns of those projects.
So are you guys in liquidation mode of your units, or what are you guys doing to prepare for this?
No, I mean, we're aggressively developing. Yeah, no, we're aggressively developing. I think we're in the early innings. You got to be really careful. Self-storage's Achilles heel is overbuilding. That's the thing I will try to overemphasize with anybody getting into the business, is that it does get overbuilt very quickly. I mean, markets like Denver, probably one of the most overbuilt markets, is just now recovering from getting overbuilt in 2016. We're just now sucking up all that oversupply. And so fighting a long entitlement battle is actually a good thing in self-storage, because that means your competitor that's coming behind you will have to do the same thing. And that's very unlikely to oversupply, versus I'll throw out, a very small market in Texas where there's a lot of land. There's a lot of growth, but there's a lot of land, and land is cheap. And you go tomorrow, 2 more people are right on your heels. And that's when you've blown your pro forma. That's when you thought you were going to lease it up in 24 months, but it took you 36 months, and interest rates have gone up. And so whatever you thought, you were going to make, you just lost. And so I always say it a lot, you find something that's not right with a deal, your first loss is your best loss. Don't be afraid to bail if it's not a great fit, because a bad investment, bad development will take the same amount of time as 10 great ones, because of how much effort you have to put in to make it work.
Yeah, no, that's totally fair. Okay, so and you're using your data, obviously, to make sure that you're not overbuilding, right, in a particular market, and you guys are going out and you're finding and you're aggressively going. So you're not liquidating any of your assets. You guys don't have any sort of how are you funding these things?
Yeah, and we're we raised a private equity fund. So our first fund was 53 million, and
Wow.
we're 100% of the equity in 10 ground up self-storage deals.
Wow.
We just closed a second fund, it'll be 35 million, but it's a GP structure. It's a GP fund. Okay. So that 35 million will be the 10%. We'll be the sponsor in the GP. We'll invest 10%, and then we'll go raise the other 90% from outside capital. Because what we found in raising a fund is that, especially fund one, not everybody can or wants to invest in a fund structure.
Right.
The preference would be project by project, and we can get better returns when we do project by project, because the real goal we have for capital is, if we match an investor's capital goals with the right type of investment, they're going to be happier because it fits what they need, and we're likely to make more money because we've given them something exactly they want. So we've finished this GP fundraise, and now we're going to go out and raise capital on a project by project basis, and that'll be anything from ground up in Hawaii to a value add asset in Las Vegas. We've got lots of projects in Miami. It's really, all over the country. There's certain pockets, there's certain places we won't invest in, but there's certain pockets that feel there's better opportunity than others.
Yeah, definitely. Okay, so you guys are doing, and are you doing any debt financing on these?
Yeah, we typically put 60 to 70%.
Okay.
construction debt. It's typically 48 month IO because we need a lot of time. That's the thing about self-storage. You might have a retail building where you build it, your tenant moves in the next day and you're stabilized. For self-storage, it takes us 12 months to build. Then it takes us 24 to 30, 36 months to lease up. So, storage is kind of a long game. You got to have at least 4 years on a ground up.
Interesting.
And then, back to what I said, if you have any blip in your lease up period or your rates, you're going to want even more time for that market to recover and mature.
So you're looking at 5-year debt on these at minimum before you're even thinking about refinancing out of them.
Yeah. I mean, the reality is, and with a couple of our banks, we have earnouts. Mm-hmm. So we achieve certain debt coverage ratios. We can increase that loan to something higher that allows us to pay some capital back. So that earnout's really valuable.
Definitely.
Or if we stabilize it early, we certainly can refi it. Today I would, if we had something that was ready, I'd put perm debt on it today because I think rates are going up. I think rates are eventually coming back down. But, we're in for a bit of a slog here, and that's going to further disrupt what we all do, which means, there's some disruption coming and there's some pain coming for commercial real estate.
Yeah, it's going to be interesting. I think it'll go up a few more points and then it'll come back to around here. We'll see, though. It's going to be interesting. That's just a thought. I'm not a financial analyst or advisor or whatever. Go consult your lawyer.
I think it's a good guess.
Yeah, it's interesting. Okay, so are you planning to sell any of them at any point, or?
Yeah, we have to sell. We're all closed-end funds, so we have to sell. Like your show is called, Capital Gains is the magic that makes commercial real estate so attractive.
Yeah.
Most of us, if this is what we do, and we're classified as real estate professionals, because that's all we do every day. We don't have to pay the Obamacare 3 point whatever %. So, it's a huge tax advantage for us. We're not a post-tax fund, but every one of our investors thinks about taxes just as much as we do. So we can't ignore that. We don't make decisions based on taxes.
It's good.
But if we weren't thinking about taxes, we certainly wouldn't be doing a great job for our investors, because a lot of them, they've got serious tax consequences and they're trying to do whatever. And that's where our Fund 2, which is really interesting. Fund 1 did not have a lot of flexibility. It was ground up, 100% equity self-storage. Fund 2, we can accommodate 1031s in and out. We can do opportunity zones. We can do some creative tax stuff. And so that's pretty attractive, because I think, back to my comment about really trying to match your strategy with investors, our group of investors, they have a lot more wealth than they did. That's just the reality of the situation. And so they're trying to be as strategic as they can to try to maximize that long-term wealth.
Yeah, definitely. And then that's a good segue into kind of what I was just going to drop on you real quick is that, one of the things that we do over here in Capital Gains Tax Solutions is we use a strategy called a Deferred Sales Trust. And what's unique about the Deferred Sales Trust, or a DST, not to be confused with a Delaware statutory trust. Delaware is you just basically 1031 into a REIT, which is cool. It helps solve some problems like a mortgage over basis or something like that. But pretty unflexible after you get it. It's pretty illiquid and whatnot. But the Deferred Sales Trust, what's unique about it is that you can exit an asset, and it doesn't have to be real estate. It can be a stock, it could be a business, it could be crypto, it could be primary home, it could be commercial real estate. It doesn't matter. Anything that's highly appreciated. And you can diversify into other assets. It doesn't have to follow the same 1031 like kind rules. It also doesn't have the time constraints. So you have, 45 to identify, 180 days to close on a 1031. In the market that we just kind of experienced, now it's starting to go down a little bit. So we'll, might find some better deals coming down the pipeline if we can get good financing for them or whatnot. But you're selling high, and then 6 months later, you're buying even higher. And so you get motivated to do it. But with this, and especially how you were talking about your partners, right? We can break up a syndication, and each individual person can take their funds, do a DST, their own, and it won't affect the next person. So if we're all in a deal, right, and we're trying to 1031, we all got to roll, and if you don't want to go, we either got to buy you out or do a tenant comment or something like that, right? We got to do some massive paperwork and shifting things around. It's a pain in the butt. With this, everyone gets their capital back. They can do a DST, and it's way easier to reinvest back into real estate when you find the right deal. So it's pretty unique, powerful tax strategy that we use, and syndicators are loving it because you can break them up. You don't have to take in the 1031 money. It doesn't affect other people. It's not. You control the timing of things, and so you can go in and out of real estate when you want, and when the deals make sense. You don't have to have that, tax tail wagging that investment.
That sounds like the commercial real estate silver bullet.
Yeah, it really is. But it works for businesses and stocks and crypto and primary homes as well. So it's the capital gains tax solution. It is. I mean, and if for your super high end clients, over the 22 million, that might drop here soon, but it moves assets outside the taxable estate. So their kids or their heirs aren't getting hit with that 40% death tax on top of it. And so it's a fantastic vehicle for tax savings. They can take distribute. It's amazing. There's
how long has it been around?
Over 26. What year are we in? 22? 26 years now. Yeah.
Wow.
Thousands of over 3,000 closes. And this is the kicker. This is what really got me. There have been 10 reviews from the IRS, all passed. No changes or anything. 12 random audits have happened on the structure. The biggest one was a $125 million apartment complex out of San Diego that was sold. They did a full deep dive on his. All 12 of those random audits came back, no changes, no findings on everything. Then there was 2 formal audits that the IRS flew this little Missouri, company that created this thing back to DC, and it's like, all right, show us what you guys are doing, because whatever. So they laid it all out there. After the formal audit, they're like, all right, this is perfect. No changes, no findings. And then they did it again a few years later because we had to have missed something. So they did it again, and they came back again, no changes, no findings. And it was audited by FINRA, no changes, no findings. So as far as the legality of it through the IRS, it is one of the most solid structures there is. I don't even think that 1031 has that. So, it's just unbelievable. Most people don't know about it because they kept it kind of preserved, because this little law firm out of the Midwest of Missouri created it, and they're like, we want to make sure we can prove the track record, number one, prove this efficacy, number two, and make sure that we test this thing before we go out and blow it up. Now we've gotten to that point where we're blowing it up.
It's a great story. No, I real estate's a small world. Commercial real estate, it's really why relationships matter. And I feel like I can get a hold of anybody, and I know of a lot of things, and there's a lot of different tools, but this thing sounds fantastic. So I can't wait to learn more about it.
Yeah, definitely. You guys can learn more about it by going to capitalgainstaxsolutions.com. And we have a mastermind every Friday, 10 a.m. Pacific, 1 p.m. Eastern. Come check it out. Drew, I actually already put your email in the invite. So if you're interested, you can come check that out every Friday.
Killer.
So,
cheers.
Yeah, definitely. Drew, if people are interested in getting in your fund, where do they go?
Yeah, best go to dxd.capital. There's a button you can sign up to talk to us about being an investor. It's really important we understand who our investors are. It's a relationship. You're trusting us, we're trusting you, so we treat it that way. I've done this for over 20 years. And as I said about the commercial real estate world, trust and reputation is really what matters. What gets you the next opportunity and the next opportunity. So it's super important to us, but you can sign up and we'll have a chat. And if you like self-storage, which if you like commercial real estate, there's a lot to love about self-storage, especially now. I mean, I've been talking for 20 years about inflation without ever really seeing it, and thinking about those office leases I signed 15 years ago or 10 years ago that were a 20-year term that had the rents go up CPI, but that are capped at 3%. I mean, can you imagine how many office, industrial, retail leases that are just like getting crushed right now? Those landlords are getting crushed because they never could track. And they were loving, they'll maybe not the office side of it, but the industrial landlords are going to love when those people move out so they can reset the leases. And anyway, self-storage just has an awesome inflation hedge. And speaking of taxes, we do accelerated depreciation on all of our assets, because you can take components of that storage facility and they're not depreciated over 39 and a half years. Some have 5, some have 10, some have 15 because of the nature of what they are. And, we want to pass, and we do pass all of that back to our investors. So, thinking a lot about taxes and structuring things around taxes with the ultimate opportunity of, if we make the most for our investors, that's how we become the most successful.
Yeah, absolutely. And that's what makes a good operator too, putting the investors first and making sure that, you guys are doing everything that you can to return that capital. So that's awesome. Okay, we're kind of coming up on our time here. So if you guys are interested, go to dxd.capital to connect with Drew and learn more about the fund and get after it.
Killer. Thanks for having me, Pierce. This is fun. Great job.
Yeah, you got it. Okay. And thanks so much, Drew, for coming on. Really appreciate it. And thanks everybody for listening to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Proven tax deferral strategies such as the Deferred Sales Trust, best way to exit highly appreciated assets tax deferred and create, preserve, and grow your wealth. Please rate, review, subscribe. See you guys on the next one.